Stocks our strategists feel are poised to deliver positive returns are featured now in their top stock picks of the week.
Hello everybody, Ben Rains here with top stock picks at Zacks. Today I'm looking at Taiwan Semiconductor Manufacturing Co., which trades in the ticker TSM. Taiwan Semiconductor Manufacturing, better known as Taiwan Semi or TSMC, or maybe its ticker TSM, is the largest and most dominant global chip manufacturer, creating a massive moat for its business and the stock. Taiwan Semiconductor physically builds the most cutting-edge semiconductors that drive AI and all other advanced technologies. It's really not hard to argue that chips are some of the bedrock of the modern economy, and Taiwan Semiconductor's clients include NVIDIA and other technology titans that have almost nowhere else to turn for their next-gen chip manufacturing needs. Taiwan Semi stock is one of the only pure-play chip manufacturers, and it's actively expanding outside of Taiwan into the U.S. and elsewhere to combat growing geopolitical concerns with China. The stock fell after its Q2 report and some comments made by Donald Trump, but the report was strong and nothing Donald Trump said really should impact Taiwan Semiconductor in the long run, and the recent selling is also part of a wave of profit-taking across big tech and chips that set up better buying opportunities for long-term investors, certainly for stocks like Taiwan Semi. So let's quickly just go over what the company did in Q2, and then we can go over and take a look at some more of what the stock's expected to do, and then some price and valuation things as well. So the company reported its Q2 results on July 18th, with revenue up 33% year over year and 10% quarter over quarter, and it grew its adjusted earnings by 30% year over year, topping our estimate by 8%. The company's CFO also said that the strong report was driven by improved demand by its industry-leading 3nm chips and 5nm technologies that was partially offset by some seasonality in the smartphone business. But looking ahead, so moving into the third quarter of 2024, the CFO said, "We expect our business to be supported by strong smartphone demand and AI-related demand on our leading-edge processor technologies." So it boosted its outlook once again. And so now we're going to go over to Zacks.com and ZRS to take a look at more of why we're so high on Taiwan Semiconductor this week and going forward. So we can see right here that Taiwan Semi is a Zacks ranked number one strong buy stock at the moment. And a lot of that is related to its strong upward earnings estimate revisions. So we can see this, some positivity on the FY 2024 outlook and 2025 since that Q2 release, up about 4% for 2024 and 6% for 2025. So that's strong outlook since that last report, even though there was some selling. And that was just because a lot of these companies had a really high bar to cross with their stocks up so much in 2024 and over the last year. So if we look overall, we're calling for about 23% revenue growth in 2024 to go from 69 billion to all the way up to over 85 billion, and then another 23% growth next year. So really impressive 23% growth both this year and next to get all the way up to 105 billion. And then the bottom line, we're calling for 23% adjusted earnings growth and then another 28% adjusted earnings growth next year. So that's a really strong top and bottom line outlook for Taiwan Semi. And then we can see even its most recent, so its most accurate estimates are coming in above the already beefed up consensus. And then it's topped by roughly 8% over the trailing 4 quarters. So that's a positive sign as well. Now we're going to go, and it's also worth noting just quickly before we move on, we go over to the start of the ticker page that Taiwan Semi pays a dividend. It's yielding about 1% at the moment. So nothing incredible there, but a positive sign nonetheless. And then overall, we can see it's trading 26% below its average Zacks price target, and Wall Street's really high in the stock. So of the 10 brokerage recommendations that we have, 8 are coming in at strong buys, with 1 buy and 1 hold. So now we're going to go back and compare that to what Taiwan Semiconductor has done recently. So they had a bit of a cyclical downturn last year, which is not uncommon at all in the broader chip space, but we can see that they've done really steady, impressive growth over the last 15 years from under 10 billion to continuing all the way up to, as we said, we're get over $105 billion in 2025. And now we can go ahead and take a look at its performance over the last, we'll see where the chart is at the moment. So this is over the last 3 years. We'll book this out to the last 10 years, and we can compare this to the broader tech sector. So we can see Taiwan Semi's up about 700% to easily double the broader Zacks tech sector. And then if we look for the last 5 years, we can see continued outperformance. And then I'll show you just with this blue line here, we can see the stock finally broke out well above its previous highs from 2022 and 2021 earlier this year. And we hit those new peaks in early July, and then we'll go here year to date so that we get a better sense. Still up 54%. But then if we go to 710, which is its most recent highs, we can see that it's pulled back significantly since then, setting up a better buying opportunity. So down 16% from its highs. And it's, as I said, it's trading over 20% below its average Zacks price target. So then if we look at the technical chart here at the moment, we can see it's now trading below that 50-day moving average. Seems to be finding a little bit of support here. It's gone from overbought RSI levels to below neutral. And then if we go on a 10-year time scale, we can see the stock might still be a little overheated. Maybe there could be a bit more of a pullback. I'll put this at the 21-week moving average so we can see if it pulls down to that red line, which is that 21-week, which is a longer dated trend line that a lot of traders are looking at. That could be a solid buying opportunity if it holds the line there. And then if it fell there, maybe you can get it a little bit lower. But overall, if you're a longer term investor, you don't want to play too much of the market timing game, in that this recent pullback is certainly a nice entry point. And then we'll quickly take a look at some of its valuation metrics. So we can see that over the last 10 years, Taiwan Semiconductor is now trading at a 33% discount to its highs. It's trading about 21. So actually roughly 22 times forward 12-month earnings, and at a solid discount to the broader tech sector, which shows that its pullback mixed with that impressive earnings outlook, setting up its Taiwan Semiconductor to look really impressive on the valuation side. So overall, Taiwan Semi is one of the most straightforward buy and hold options in all of technology, in my opinion, alongside the likes of NVIDIA and others, because chips are the lifeblood of the economy and then all of tech. And Taiwan Semiconductor is the chip manufacturer. So that does it for me. And I'm going to send it over to Brian Bolin.
Well, that was a great stock pick from Ben Rains. Thank you very much, Ben. And now it's my turn. I'm Brian Bolin. I'm the aggressive growth stock strategist here at Zacks. And my stock pick for the week is Vertiv. And let's just jump right into the screen, shall we? Vertiv is VRT is the ticker. So there's the name of the company. VRT is the ticker. It's a Zacks rank, a number one. It is a strong buy. A B for growth and a D for value, and that gives me that growth divergence that I like to see. The Zacks style scores are a great method of finding out what kind of investor is looking at this particular stock, or at any particular stock. A strong growth score and a weak value score tells me I'm on the right path, because growth investors and value investors are inherently looking for different things. All right, we've got a $28 billion market cap and a 10-cent divvy that gives you a 0.13% yield. As we look at the chart, we see an earnings event and then a flush straight down. Straight down is not what you want to see on a growth name. So we'll talk about this in a second, but the stock went a little bit lower there after reporting earnings. This company is involved in the data centers and keeping those data centers cool. And there's been that big buildup in AI data centers and all of that. So if that trend continues, the stock will probably rebound. All right, let's take a look at the earnings history. We got an 18% beat here, at 3%, 16, and a 13. But the stock went down. Now, does that change earnings estimates? So we can see that the estimate was 65 cents 7 days ago. It is up to 70 cents. Next quarter hasn't really moved that much, but up from 76 to 77 cents. There's a penny there. And then the full year goes from 242 to 258, 313 to 331 for next year. Those arrows are all pointing in the upward direction. So let's take a look at our top line growth. What do we got? What do we got up here? We got 11.8% growth this year, accelerating next year to 13%. And we're going to catch 7.6 billion. We're going to add a full billion on top next year. Growth story is really still intact, but everyone's worried about what the conference call just talked about. Well, let's just do our valuation metrics here. 30 times forward earnings. It's a little bit more than 2.2 times price to sales growth type idea there. So we're looking at 12% top line growth in the most recent quarter. Your book value awfully high at 20 times. That's why the value investors don't like it. 4 times sales. Where have margins been going? Well, good question. Margins are going from 10% to 11% and just about 12%, 11.75% in the most recent quarter. So margins moving up, sales moving up, everything looking good. Do the chart. This is what we normally do. We say there's a pandemic, we're all going to die, and things bounce back. A tech wreck in 22, which didn't really hurt this stock as it was down low. Then your AI boom. And this thing boomed up over 100 and has come in. And then that 12% decline there on that most recent earnings event. So the problem was that their one segment, it was expected to have 60% growth. And the company then guided to only 10 to 15% growth. The story remains the same, though, even though that one segment is cooling off, that there is still going to be growth this year. There is still going to be growth next year. And when we have earnings growth and operating margins moving higher, that means we're going to have higher earnings, and that's going to propel the stock higher. So a buy on the dip, if you will. It's still down. I saw a trade, a Gallo resistance at $80 a share. I think it's down in the $77, $76 range right about now. But I believe it's a good stock for you for this week. All right, that's it for this week. Be sure to join us next week when we look at 2 more top stock picks for the week. And until then, why don't you go to Zacks.com/promo to check out all of our latest promotions.